Warren Buffett has always understood something most investors learn a bit too late. If you're stuck in the wrong industry, then even the best-run companies can become terrible investments. That's because the market is constantly rotating beneath the surface. Then when you understand that, then any industry flaw will be exposed and the group will be out of favor for a long, long time. That's why I took a deep dive into 4 areas of the market that are flashing warning signs to stay away. Today, I'll show you the data behind each one, why the risks are getting worse beneath the surface, and potentially ways to pivot so you can stay ahead of the game. Hey everyone, I'm Reitmeister. I'm a 40-year investment veteran and former editor-in-chief of Sachs.com. Now, at WallStreetZen.com, where I'm a partner, our quant team tracks over 4,600 stocks across 115 different factors. And one lesson keeps showing up over and over again. Weak industries have the power to drag down almost everything inside of them. And if you appreciate straightforward, data-driven investment insights like this video, then hit that like button now. And remember, none of this is personalized investment advice. Always do your own due diligence before putting your hard money to work. Okay, now on to the good stuff. Starting with industry number 1 to avoid in residential construction. On the surface, housing always sounds like a safe bet because people need homes. The population keeps growing. What could go wrong? Okay, quite a bit actually when you look underneath the headline numbers. The residential construction industry is rated F according to the Zen industry rank model. That's the lowest possible score, which points to likely underperformance for the group in the months ahead. Note that when an industry gets an F rating, it means weakness is showing up in the group's fundamentals. Key areas like growth, financial strength, sentiment, and valuation. And right now, residential construction is one of the weakest areas in the entire market. And by the way, you can look up any stock and see its industry ranking on our quote pages at WallStreetZen.com. It's not just the home builders themselves. Look at the surrounding ecosystem. You'll see the same story repeating. Lumber and wood production, F. Home improvement retail industry, F. Building products and equipment, D. Not that much better, right? These are the industries that feed into and depend on residential construction, and they're all flashing warning signs together. When an entire supply chain is rated this poorly in unison, that's not a coincidence. That's a serious structural problem. And when you pull up the individual home builders, that picture doesn't get any prettier. Some of the biggest names in the industry like D.R. Horton, Lennar, Pulte Group are sitting with lowly ratings. These aren't obscure small caps. These are the flagships in the industry, with $20 billion market caps. And the data is waving a straight-up red flag. That's what makes the industry tricky. It doesn't look broken, the stocks aren't in free fall, but the momentum has turned. The fundamentals are softening, and the data isn't giving you a reason to step in and buy. Here's the core problem. Home builders are getting squeezed from every direction all at once. Mortgage rates are still elevated, which means buyer affordability is quite low. Demand hasn't fallen off a cliff, but it's soft, and the trajectory isn't encouraging. Meanwhile, tariffs on imported lumber and building materials are pushing construction costs higher at exactly the wrong moment. That's unwanted margin compression that won't resolve itself in a quarter or two. If you look at the balance sheets, then you'll see meaningful debt loads across the industry. This is a double whammy given that the rising rates also escalates costs on all that borrowing. When you're a cyclical business, leverage to the hilt with the cycle moving against you, that's a setup where real capital loss can happen. Not paper losses you can wait out, actual damage to your portfolio. The lumber wood production industry, as we mentioned, tells you the same story. It's rated F, right? A lowly industry rank. These companies are direct derivatives of home building demand. When construction slows, they feel it fast and with less pricing power to absorb the hit. Now, I want to be clear. Avoiding residential construction at this time is not the same as saying housing is broken forever. Long term, there could be a real demographic tailwinds. But right now, the risk reward is poor given the data in hand. Gladly, there are significantly better places to put capital while this industry works through its issues. When the Zen ratings are this low across this many names in one industry, that's not noise, that's a pattern worth respecting. But I don't want to leave you hanging. Gladly, there is a way to get construction exposure without the housing headwinds. You will find that in the engineering construction industry, which is an A-rated group. This group is in much better health because it is focused on infrastructure like bridges, roads, energy projects, and yes, AI data centers. They have dramatically more demand and better prospects in the days ahead, so do consider some top-rated stocks in that group. Hey, if you're getting some value out of this video so far, then please subscribe and hit the notification bell. I release videos like this often, and this is the best way to ensure you don't miss any of the next ones. Okay, Let's move on to the second industry to avoid in traditional media and entertainment. This industry is filled with names everyone will recognize, the kind of large media companies investors have felt comfortable owning for decades. But perhaps now is the time to think twice about that notion. Here we are talking about broadcast networks, film studios, entertainment giants, and that familiarity is exactly the problem. Because the same business model that built these companies into giants is now the one that's being dismantled. The industry rank data is blunt, straight up Fs for broadcasting as well as entertainment stock. Even adjacent areas like telecom services are sitting at C. Not broken, but clearly under pressure. Look at the actual companies. Paramount, Warner Brothers, Discovery, traditional broadcasting groups, none of them are in buy territory. These aren't fringe players. These are the legacy giants. Let's drill down into Paramount, for example, with a simple PSKY. It operates in an industry under real structural strain. Rising content costs, streaming fatigue, and changing viewing habits are all eroding the old model. This used to be a dominant media franchise, a legacy player with decades of brand equity and cultural relevance. Right now, that legacy is more like dead weight around their necks. The stock reflects that reality, with shares down from $50 just a few years back to around $10 today. The Zen ratings tells why, with a mediocre C rating, actually in the bottom 40% of all stocks based on its lackluster fundamental profile. The weakness becomes all the more clear as we dig into the component grades. Bottom 50% for value, bottom 46% for sentiment, bottom 27% for financials, bottom 25% for AI timeliness factor, and bottom 12% for momentum. There is simply nothing to like in this makeup. Here's the main issue. The cable bundle is unwinding, and it's not just slowing down. Cord cutting continues to accelerate. Consumers are leaving traditional TV faster than expected. At the same time, advertising revenue, which used to be more concentrated and predictable, is now fragmented across dozens of platforms. Then comes streaming. On paper, it looks like the solution. In reality, it's a different problem altogether because the economics don't work the same way. Legacy media companies are spending billions building streaming platforms. They're competing directly with companies like Amazon and Apple, where content is just one part of a much larger, more profitable ecosystem. For them, streaming doesn't have to be highly profitable, but for traditional media, it most certainly does, and that's a losing proposition. Even live sports, perhaps the last real moat in this group, is starting to erode. Leagues are increasingly selling rights directly to streaming platforms or tech players. So now you have high fixed content costs, falling revenue per user, and increasing competition for viewer attention. That's margin compression at scale, and not very attractive. There's also a management problem here. Many legacy executives have been slow to fully accept that the cable bundle is structurally dead. And you can see that in capital allocation, continued investment in a model that no longer works. So what investors are often seeing isn't transformation, it's an ongoing and steady decline. But I want to give you something you can use here. So if you want exposure to entertainment, then there is actually a better way to go about that with the Electronic Gaming and Multimedia Group, which is B-rated, and yes, A and B-rated industries offer the best odds of outperformance. The difference is fundamental. Gaming isn't trying to replace an old model. It is a new model all to itself. Digital distribution, recurring revenue, global audiences, better monetization per user. It's perfectly aligned with how people actually consume entertainment today. Similar end market, completely different economics, better results. Now we're rolling on to the third industry to avoid at this time, and that's commercial real estate. This is an area that felt safe because for decades it most certainly was. Experienced investors have owned commercial real estate either directly or indirectly as stocks or REITs since the beginning of time, or at least it feels that way. Commercial real estate has been a valued part of portfolios as a source of income, diversification, and stability. And let me pause to clarify. I'm not making a broad argument against real estate. This is specifically about office real estate. The danger here is false familiarity because REITs don't feel risky. They feel like a ballast in the portfolio, something steady and income producing. But our Zen industry rank is telling a very different story, and it's quite negative. REIT office space is F. REIT retail F. REIT diversified, F. REIT mortgage, F. REIT hotel and motel, F. You get it? Right? That's not one weak pocket. That's an entire category flashing red at the same time. And when you look at individual office names, that negativity becomes all the more concrete. Companies like SL Green, Vornado, Cousins Property, Kilroy, these are some of the most recognized office REITs in the market. And all these individual stocks are sitting in the lowly D and F range in the Zen ratings thanks to truly terrible fundamental profile. Let's take SL Green Realty as an example. It's one of the largest and most well-known office REITs, yet it carries an overall F rating, putting in the bottom 5% of all stocks we analyze. The stock is still trading at nearly half its pre-pandemic level, even 6 years later. This clearly points to a structural shift in the industry. So what's actually going on here? The core issue is structural, not cyclical, thanks to work trends in the post-COVID era. Yes, a lot of people have gone back to their offices, but many others have not. Remote and hybrid work are still very real things, and as such, office utilization today is still dramatically below 2020 levels. More importantly, tenant behavior has changed permanently. Companies are renewing leases for less space, often at lower rents, and in many cases, not renewing at all. So you have declining demand, declining pricing power, rising vacancies all happening at once. Now layer in the balance sheet problem. These buildings were financed with serious leverage under the assumption of stable, predictable rental income. But when the income drops, the math breaks down quickly. In many cases, rental income no longer comfortably covers debt service, and that may be part of why you're seeing something that catches a lot of investors off guard. Property values are down 50 to 60% in certain office-heavy markets. Importantly, that doesn't mean they're cheap. This is where the value trap shows up, because distressed prices may look like an opportunity, but actually looks can be quite deceiving. If the underlying cash flow is structurally impaired, then the cheap asset can keep getting cheaper. There's also a narrative that sounds logical on the surface, that being the office to residential conversion, as in turning empty offices into apartments, and voila, the problem's solved. Except it rarely works economically. Office buildings and residential buildings are designed completely differently. Floor depth, plumbing systems, and electrical layouts all have different requirements. The cost to convert often exceeds the value of the finished property. Some buildings will convert, but the most of them will not. And the risk doesn't stop at real estate investors. It spreads. Regional banks hold a significant amount of commercial real estate debt. As borrowers struggle and collateral values fall, that stress moves directly into the banking system. This isn't theoretical. It's already happening. So this is a bigger than just a bad real estate. It's a broader financial risk channel. To be clear, not all stocks related to commercial real estate are broken. For instance, one pick that's been flashing the Zen Ratings radar lately is Jones Lang LaSalle with the symbol of JLL. That's because they don't own commercial real estate. They just offer a wide range of services the industry needs, leading to ample growth. Yet JLL seems like an isolated island inside a very troubled sea of commercial real estate. At some point, things will rebound for this group. Until then, I would stay as far away as possible. By the way, if you like analyzing stocks and industries, this is the kind of analysis I walk through live every Monday at 7 p.m. Eastern Time. Not just what stocks and industries I'm buying or watching right now, but how I'm finding that and how you can do the same. I also share my hand-picked stock of the week, blending the power in the Zen Ratings model, along with my greater than 40 years of investing experience. All this and more is part of our live training session this coming Monday at 7 p.m. Eastern. It's totally free. Just sign up at WallStreetZen.com/live. You'll also find a link in the description or scan the QR code on your screen. Hope to see you there soon. Our fourth and final industry to avoid is speculative technology. I need to explain this one a little bit more because I actually disagree with Warren Buffett a bit here. Because if you listen to Buffett literally, then you would avoid a lot of technology entirely. Clearly, there's been a lot of growth in tech that directly benefited investors. But I think Buffett's framework misses an important reality in 2026. Some technology trends are absolutely real and enormously investable. AI is real, for example. Advanced computing is real. Data center expansion is real. The mistake for investors is confusing transformational technology with speculative companies. And that distinction matters. Because when we look at the data, there's a huge gap forming between profitable picks and shovels tech companies and the speculative story stocks riding the hype cycle. For example, semiconductors currently have a solid industry rank of B, whereas electronic components or even stronger with an elite A grade. These businesses already generate real cash flow. They benefit directly from AI infrastructure spending. And most importantly, they don't need a perfect future scenario just to justify today's valuations. But on the other side, you still have some of the most speculative corners of technology getting crushed. For instance, the software application and software infrastructure both carry B industry ratings, but those averages are being supported by a handful of dominant, profitable incumbents. Underneath them, many smaller speculative names are still deeply underwater, and that may be the real lesson here. In a low interest rate environment like earlier in the decade, investors could fund almost any story. Growth alone was all that it took. Today, profitability and cash flow matters again. In fact, it matters a lot. Take Veritone as an example. The company became a major AI narrative stock during the post-pandemic boom, built around its AIware platform and massive AI ambitions. The story sounded incredible, with shares surging over $40. Sadly, today it's knocking around $2 per share. The problem is the fundamentals never caught up with the story. The business remained unprofitable, they burned cash, and once rates rose, the market stopped rewarding the growth narrative. Today, the stock trades 95% lower. That's the danger zone with speculative technology investors need to fully understand. The future technology may absolutely be real, but that does not mean that every company attached to it will survive long enough to benefit from the trend. And that's where Buffett's core principle still matters enormously. Stay inside your circle of competence. Focus on businesses with understandable economics, measurable cash flow, and durable demand, because you do not need to own every exciting story to build wealth. You just need to avoid getting trapped in the ones where the economics never actually pan out. Gladly, the Zen ratings, including our industry rank, can truly help here. They're designed to separate strong businesses with real momentum and financial strength from speculative stories where the economics simply don't add up. The industry rank shows where market leadership is developing. The individual Zen ratings help identify the strongest stocks within those winning groups. The Zen ratings and industry rank played a key part in my identifying and subsequently adding Micron Technology with a symbol of MU to my Zen investor portfolio. Here is a stock benefiting from one of the greatest tailwinds in the market right now. And despite gaining well over 500% in the past year, both analysts and the Zen ratings still rated a strong buy, given its still exciting upside potential. So what differentiates this stock? Micron is not just riding a short-term AI hype cycle. It sits at the center of a multi-year demand wave for high bandwidth memory and data center DRAM. These are both becoming essential for just about every AI and cloud computing related model. This stuff isn't going away anytime soon. Here again, not speculative. And related to that, it's a top-rated stock in a top-rated industry. So the bigger picture lesson remains intact. Success isn't just about chasing the most exciting growth story. It's about owning stocks in strong industries with strong data behind them. These are the four areas of the market that may look safe on the surface, but the data reveals serious concerns. What do you think? Do you agree or disagree with the four Buffett-inspired industries to avoid? Please let me know in the comments section below. And if you like this video, then make sure to check out this video featuring 8 rules Warren Buffett learned from the famed book, The Intelligent Investor. It's coming up on your screen now.